Hey guys, this is Riado and welcome back to the channel. This is part 2 of my Palantir stock analysis, and if you're interested in watching part 1 where I talk more about the company, its competitive advantages and its growth metrics, you can find the link to part 1 in the description down below. With that said, let's jump right into part 2 of the analysis. Now let's look at the profitability of the company. For reference, I've included adjusted margins to assess if profitability is improving if SBC or share-based compensation is excluded. That said, 2022 gross profit was $1.5 billion, which is a 79% gross margin and an 81% gross adjusted margin. And in Q1, gross profit was $418 million, which is an 80% gross margin and an 81% adjusted gross margin. We can see that gross margin has been improving steadily over the last few quarters, and this is due to the gradual drop in SBC expenses baked into cost of revenue. Nonetheless, Palantir has really high gross margins, which shows high earnings potential. Palantir also reports contribution margins, which is a measure of operational efficiency in terms of deploying its software to customers. So contribution profit, which is gross profit minus sales and marketing expenses but excludes share-based compensation, was $1 billion in 2022, which is a 54% contribution margin. In Q1, contribution profit was $279 million, which is a 53% contribution margin. As you can see, contribution margin has been trending downwards over the last few quarters, which shows management's priority in ramping up sales and marketing expenses to acquire as many new customers as possible. Therefore, it is reasonable to assume that contribution margins could downtrend further in the short to medium term. Turning to operating profits, Palantir had an operating loss of $161 million, which is a negative 8% operating margin and also a 22% adjusted operating margin. So the huge difference in GAAP operating margin and adjusted operating margin is due to high stock-based compensation baked into operating expenses, which is not included in non-GAAP measures such as adjusted operating margins. That aside, Palantir has been operating at a loss since the beginning of time, but that all changed in Q1 when it achieved GAAP operating profitability for the first time in its company history. So in Q1, operating profit was $4 million, which is a 1% operating margin and a 24% adjusted operating margin. So that is a really positive development for the company, and I expect this trend to continue moving forward as the company scales further. On the other hand, net loss for 2022 was $371 million, which represents a negative 20% net margin and a 7% adjusted net margin. The heavy GAAP losses is primarily due to $272 million of net unrealized and realized losses from its investments in marketable securities, namely the SPAC investments that Palantir made over the last 2 years. Here you can see the companies Palantir invested in, and as you may or may not know, some of these SPACs have lost a significant amount of their value relative to their net asset value of $10 per share, which explains why Palantir's bottom line is significantly affected. So here are some examples of the companies, and as you can see, they are way below from their net asset value per share of $10 where Palantir initially invested in. With that said, Palantir reported its second consecutive quarter of GAAP net income profitability in Q1. So Q1 net income was $19 million, which represents a 4% net margin and a 20% adjusted net margin. While everyone is so happy about Palantir being a profitable company, I want to point out that Palantir was profitable in Q1 solely because of higher interest income. So get this, compared to Q1 last year, interest income increased by $20 million due to higher interest rates and new investments in US Treasury securities. So excluding interest income, Palantir is actually still unprofitable. So yes, that is something to keep in mind of. All in all, Palantir has strong earnings potential given its high gross margin profile of 80% plus. The company's profitability metrics are also improving across the board, which shows economies of scale and operating leverage. Although things are trending in the right direction, Palantir is still barely profitable on a GAAP basis due to high stock-based compensation expenses. but hopefully we can see that improving over the next few quarters. Moving on to the balance sheet, Palantir has a fortress balance sheet with $2.9 billion of cash and short-term investments, with $260 million of debt, which is mostly in the form of operating lease liabilities. As such, Palantir has a net cash position of around $2.6 billion, and as you can see, it is trending upwards with each passing quarter. Current ratio is about 5 times, which is very healthy, and the company also has $950 million of borrowing capacity under its credit facilities, all of which remain undrawn. So overall, a strong balance sheet for Palantir. More importantly, Palantir is already free cash flow positive, generating $184 million of free cash flow in 2022, which represents a 10% free cash flow margin. This is actually a decrease from 2021 levels, and this is due to the timing of receipt of payments from customers and timing of payments to vendors. So the increase in sales and marketing expenses to scale the business is also a contributing factor to lower free cash flow margins. In Q1 though, free cash flow was virtually equal with the entire of 2022, generating a free cash flow of $183 million, which is a 35% free cash flow margin, and this is due to more favorable timing of payments from customers. Nonetheless, I believe Palantir can achieve and sustain free cash flow margins of 30% plus in the long run. With high free cash flow and a high net cash position, Palantir can use cash in hand for other important things such as expanding its product line or even buy back shares. But instead, Palantir bought $1.6 billion of marketable securities, net of sales and redemptions of marketable securities. And it seems that Palantir wants to park their cash in treasuries and get high interest income in this high interest rate environment. And despite the strong balance sheet and cash flow, Palantir needs to manage SBC spending to create real shareholder value. Turning to outlook, management provided the following guidance. Q2 revenue is expected to be $530 million, which is about a 12% year-over-year growth. So Q2 revenue is expected to decelerate significantly from Q1's 18% growth, which sounds terrible. And Q2 adjusted operating income is expected to be about $120 million, which is slightly lower than Q1's figure. On the other hand, full year 2023 revenue is expected to be about $2.2 billion, which is about a 16% year-over-year growth. In other words, Q2 revenue is expected to decelerate, but revenue in the back half of the year is expected to re-accelerate. That said, 16% annual growth rate is nothing to be excited about. And for adjusted operating income for the year, it is expected to be about $506 million to $556 million. So to sum it up, guidance is quite disappointing, but I think the markets completely ignored revenue numbers, but instead focus on GAAP net income profitability, which management mentioned that they can achieve for each quarter this year. In other words, profitability is sustainable and improving, and I think that's what the markets like to hear. On the other hand, according to its shareholder letter, management is seeing strong demand for AIP, which will be made available to select customers this month. The company also mentioned that they are currently negotiating terms and pricing for access to the components of the platform. And I think it is more likely for existing customers to adopt AIP and scale with Palantir, which again reinforces high switching cost modes. So that is a positive development for Palantir, and we can expect AIP to contribute to revenue growth in the coming quarters. It is also worth mentioning that Palantir closed $397 million of total contract value in Q1, which is up 60% year over year, and billings of $614 million, which is up 25% year over year. The growth of these metrics are important because it tells us about Palantir's deal pipeline, which will eventually be recognized as revenue. So seeing that total contract value and billings are both growing faster than revenue means that there's higher growth potential than meets the eye. This is of course supported by the 64 deals of at least $1 million closed in Q1. So again, strong deal pipeline for Palantir. And if we head on to Seeking Alpha, we can see that analysts expect earnings per share of 21 cents in 2023 and continue to improve from there. And in my opinion, 26 cents and 34 cents in 2024 and 2025 respectively seem a bit low, and I think 30 cents and 40 cents respectively are more reasonable estimates. On the other hand, revenue is estimated to grow 16% year over year in 2023, which is in line with management's guidance, and then analysts expect growth to re-accelerate in the following years. So if we look at Palantir's actual versus consensus revenue numbers, we can see that Palantir has beaten expectations in all of its quarters ever since the company went public. So I expect Palantir to continue to outperform expectations moving forward, especially with the recent development of AIP. Now let's get to the most sensitive part of today's video, Palantir's valuation. If we look at Palantir's price chart, we can see that Palantir's stock has crashed more than 80% from its all-time highs of $45 to about $6 a share in December. Since then, the stock has recovered from its lows, and we can see that most recently, the stock has rallied more than 70% ever since it released its Q1 results. Probably because of the AI hype and the company guiding for GAAP net income profitability. But let's take a look at valuation multiples to see if Palantir is still a reasonable buy today. Here, I've included Palantir's EV to sales multiple and EV to gross profit multiple, and as you can see, EV to sales multiple has traded as high as 55 times and EV to gross profit multiple has traded as high as 90 times. And today the company trades at an EV to sales multiple of 12.2 times and an EV to gross profit multiple of 15.5 times. So this is still a significant discount to historical multiples. But if we head back to Seeking Alpha, we can see that Palantir has a valuation grade of D, which is quite bad, and that means the risk to reward is not good based on Seeking Alpha's valuation algorithm. That aside, let's look at Palantir's valuation compared to some of its AI peers. As you can see, Palantir seemed to be valued more expensively compared to C3.ai, Google, and UiPath. On the other hand, Palantir is slightly undervalued compared to Microsoft, which of course has investments in OpenAI and ChatGPT. But it's also worth considering that Palantir is growing faster than its peers, including Microsoft, which is why I think the valuation premium is well justified. Wall Street analysts are pretty much divided on the stock with an average hold rating on the stock, and here you can see that there are 4 strong buys, 9 holds, and 3 strong sells recommendations on the stock. Wall Street also has an average price target of $9 a share, which is a 26% downside from current prices. And as you can see, there's a huge range in price target with a high of $15 a share and a low of $5 per share. I've also created a DCF model on Palantir, and as you can see, these are my key assumptions. Revenue growth for the first 3 years follows analyst estimates right here, so I'm just gonna plug this into my model and then gradually drop revenue growth rates to just 14% by the end of 2032. For gross margin, I expect it to be 80% in 2023 and then gradually improves over the years as the company achieves economies of scale. So cost of revenue is gonna drop from 20% all the way down to 18.2% by the end of 2032. The same goes for operating expenses. I expect it to drop from 75% to 50% by the end of 2032 as the company gains operating leverage. Income tax will eventually grow to 20% of operating income, and for depreciation and amortization, I'm going to keep it at 1.2%. Stock-based compensation is likely to remain high in the next few years, but I expect that to drop over time to just 7% of revenue by 2032. For capex, I'm going to use the 5-year average of 1.7% of revenue, and I'm going to use that for the remaining years. And for changes in net working capital, I'm just going to keep it at 0%. With that said, I expect a long-term free cash flow margin of about 32% by 2032 for Palantir. If we look at the big tech companies' free cash flow margin, we can see that Microsoft has a free cash flow margin of 33%, Apple has 28.2%, and Google has 21.2%. I will assume Palantir's free cash flow margin to be at the higher end of this range since it is a pure software business. It is also possible for Palantir to surpass Microsoft's free cash flow margin, but I just want to be conservative in my model here. So again, based on these assumptions, I arrive at a $9.5 billion revenue by 2032 with a free cash flow margin of about 32%. And if we assume a discount rate of 10% and a perpetual growth rate of 2.5%, I arrive at an intrinsic value per share of $12.69 per share. This is of course much higher than the average analyst price target, but I think my DCF model seems reasonable. So based on my DCF model and based on the current price of $12.23, Palantir seems to be trading at fair value. There's no margin of safety here, so if I were to start a position or add to my position, I would wait for a pullback before doing so. And also, if the stock moves higher, perhaps to the $15 level, I will start trimming my position a bit, but that's just my opinion and it's not financial advice. On a side note, institutions have been buying Palantir shares on the way down, and most notably, Cathy Wood's ARK Innovation Fund has been buying Palantir recently after the fund dumped shares last year, and that I think gave investors a lot of confidence, which is why the stock has been surging lately. And also, management mentioned that they expect the company to be included in the S&P 500 within the next few quarters, so that will mean a larger pool of institutional investors, which can drive the stock price higher. With that said, I think momentum on the stock is changing to the upside. I mean, the stock has been trading sideways for over a year, and now the stock is breaking out due to renewed optimism. And I think there are some catalysts that could push the stock even higher. That includes improved profitability, the official launch of AIP, as well as insiders buying shares. As you can see, one of the bear theses against Palantir is that insiders have been selling the stock ever since the company went public, with not a single buy from them. So if we see just a small buy from management, I think Palantir stock could go wild. Turning to the risks, the first major one will be that its strategic investment partners going bankrupt, or most specifically, its SPAC investments. So most of these companies are unprofitable, or even worse, some of them are barely generating any revenue. As such, there's a strong likelihood that some of them will eventually go bankrupt given the tough macro environment. When this happens, Palantir's revenue will be negatively affected and its customer count will decrease as well. The second risk is of course dilution. This is perhaps the most controversial topic when it comes to investing in Palantir. While SBC as a percentage of revenue is trending downwards, 20% plus of SBC is still very high. As a result, shares outstanding has increased roughly 30% from 1.6 billion in 2020 to 2.1 billion today. So here's how dilution works. If you think Palantir deserves a $50 billion market cap with 2.1 billion shares outstanding, Palantir should be priced at about $24 a share. But if SBC remains high, shares outstanding is likely to increase, and let's say it increases to 2.5 billion. Then a $50 billion market cap means that Palantir will be priced at $20 a share, which is about 20% lower than what it would have been if shares outstanding remain at 2.1 billion. So that's dilution, which pressures upside potential. And if you look at some of the big techs SBC spending as a percentage of revenue, you can see that it is tiny compared to Palantir. And as you know, these companies have given monumental returns for shareholders in the past decade or so. So in other words, Palantir needs to control its SBC spending if it wants to create real shareholder value. So to wrap up this video, the ultimate bull thesis for Palantir is that Palantir is going to replace legacy data and operating systems through its core platforms Apollo, Foundry, Gotham, and AIP. The company has a long growth runway ahead due to developments in big data analytics and artificial intelligence, and although growth is slowing down, the company has a strong technology, high switching costs, and high barriers to entry moats that should support its growth ambitions. On the other side, SBC spending and dilution is still a problem, but it is trending in the right direction and the company is turning more profitable with each passing quarter. So despite the recent rally after Q1 results, I think there's still more upside potential for the stock due to improved profitability, the official launch of AIP, and S&P 500 inclusion. I'm not saying that there's no more downside. I'm saying that momentum is shifting and it seems that there's more reasons for more upside than downside, and for those reasons I'm holding my shares in Palantir stock. Well, that is it for today's video. I want to know your thoughts on Palantir. Do you think it will be a potential multi-bagger? If not, here's a video where I talk about a stock that could be a potential multi-bagger in the next few years. With that said, thank you so much for watching this video. Don't forget to hit the like button and subscribe to my channel for more investment content. See you guys on the next one.